Hi traders, and welcome to this week's edition of the Keyzone Traders Trade of the Week. And this week we're going to look at a trade that we took yesterday, and we're going to talk about how, as a price action trader, it's really important that you understand what the market is communicating to you in the price action and how the different types of price action communicates different things, so that you can then manage your trade appropriately. So let's go take a look at the charts. Hi traders, so this week we're going to talk about how understanding price action and the sort of price action we teach in our Keyzone Traders Academy, how important it is to be able to understand that so that you can help you manage your trades. Now, this is a trade that we took in the FTSE. It's going to get quite advanced, but hopefully it will illustrate the facts that I've just said about how important price action is, especially when you are a price action trader and technical trader. So this was our report yesterday. We said that the FTSE needed a sustained break above 75.78 to 86 initial resistance to see a move towards the next upside target at 76.29 to 76.37. And now we're going to have a look at how price reacts to that as support and then resistance, and the difference in the price action, which gives you the clue as to what I'm talking about in terms of how it's communicating different things to you in the market. So we wanted to gain acceptance above this zone here to see a move higher towards this zone up here. However, we got this strong push up above here, and we got this false break, this liquidity grab signal here that we talk about all the time in these sessions. So we'd gone into the resistance zone, we'd gone above it, we'd grabbed that liquidity, we'd taken out the stops, and then we closed back inside that zone. The next candle done something very similar, but it closed right on the top of the zone. So we had another attempt to push up, and we came down. The next candle, we came and we tested that zone quite deep, but we still held it as potentially support. So with this being a key zone, my thought process is one of two things. I'm pretty sure I can get a trade around this zone, but it's about trying to find the correct trade. Now, if this is a false break, what I want to see is I want to see the move down, then it pulls. So I want to see a move down below the zone, a pull back into that zone, and then I can look to get short on a retest and a break back down. However, if we start breaking up, what I'm thinking is that then becomes the potential for getting long, because we've had the push up, we've had the attempt a couple of times to push higher. If we then come down and hold this zone as support and start breaking higher again, I then think that it's okay to get long. So I actually entered a long here at 89, and I had a stop here, down here at 75, below the zone. And I had a target, 2-to-1 risk to reward, up towards that zone. We had the zone up here, so I just wanted to front run that zone, get a nice 2-to-1 risk to reward trade on that. So that was my thought processes, and that was my trade, 75.89 there. So we then got triggered into this trade. We come down, we retested the bottom of that zone, and then we put in this sort of continuation pattern. And again, this was more confirmation that it was holding this zone of support, and if we broke up, we potentially had a breakout scenario. We got triggered into the trade, and as you can see, the market generally just chopped around. We had one attempt here, another attempt to break up here, but we then failed again, and we just started to chop around quite a bit. Now, it was still okay at this point because we were holding that zone as support. However, this is a breakout trade, and with any breakout or momentum trade, the clue is in the name. You want them to get on with it quite quickly. You want that order flow to communicate to you that the buyers, in this instance, are still in control of the market. And if the market is quite consolidatory, if it's quite corrective, that suggests that the market's quite balanced and there isn't an imbalance of the order flow. So one side is not more dominant over the other. And the longer that goes on, it becomes a little bit more concerning. Now, this is where it gets quite important in terms of understanding market behavior and understanding price action. Now, notice the high of this candle up here is 75.93 spot 1. So the highest traded point on the cash session at that point was 75.93 spot 1. We then meandered around and we just took out that high there, 75.93 spot 1. We took out that high, 75.93 spot 4, and we put this strong candle, reversal candle in. Now, as you've all heard me talk about so many times, price likes to just take out swing highs and lows, grab that liquidity, and then it will potentially reverse and go in the opposite direction. So knowing this and understanding this, as soon as we took that price, that previous high out, it done that liquidity grab, it had taken those stops, and then reversed quite sharply. That for me is a warning sign that, you know what, we haven't had the momentum, we haven't continued to break out, and we've got that market behavior, that repetitive market behavior, whereby it's just taken out that high and put in a strong reversal candle. I'm like, right, okay, you know what, there's a lot, although this zone has still held as support, in the back of my mind, I'm thinking, right, there's a lot of things here. It's not doing what I want. It's not got that momentum that I would like to see. I'd been in the trade for a while. It had taken out that liquidity and put in a reversal candle. I just want to come out at break even and look for a stronger signal. So I came out of this trade as this candle retraced and got out at break even. And as you can see, it eventually went down and hit my stop. Now, what I then want to talk about and show you, so that's how managing the trade can be so important. I then want to show you the difference in the price action. So we got this really strong push down here. Notice how we started holding the 8 moving averages. So we got it's that false break scenario that we spoke about. We then got this push back into the zone. So we failed to get a sustained break above the zone. We then got the strong pushback below it, so it's a bit of a false break signal. But notice the difference in the way that the price reacts when it has now broken down through that zone and it's looking to use that zone as resistance. It then puts in that reversal candle, that continuation pattern there, and notice how quickly it continues. That there is communicating to you that the sellers are in control. They are dominant. The dominant order flow in the market. So if you manage to get short on this trade here, you're comfortable in that trade because it shows that the sellers, you're with the dominant order flow, and you can come down. You could have got quite a nice trade out of that. Whereas here, if you manage to get long on this candle here, the market is communicating to you that there is no imbalance of order flow. It's quite balanced, and then as soon as it creates that market function, that repetitive market function of taking out stops and reversing, that's your warning sign to get out the trade. So like I say, I understand this is quite in-depth and quite advanced techniques. However, hopefully you can see the difference in the price action, how important it is to understand the price action and what is communicating to you in real time to be able to manage those trades. So I hope you found this useful, and I'll speak to you again next week. Have a great weekend.